Alright guys, this is going to be a quick video. I'm going to show you the relative momentum index, which is what I like to use on my chart. I like to use it over the relative strength index just because with the RSI it shows a lot of noise, so you'll see a lot of jittery lines. I like to keep my chart a lot simpler. It's easier for me to read, easier for me to navigate, it's easier for most people to follow. Basically on the top right corner of your chart on Thinkorswim, there's this icon right here. You're going to click it. Go to Studies, go to Edit Studies. You're going to type in relative. Alright, so here's the relative momentum index. I'm going to double click on it. It's going to go to the lower portion. You can hit apply, and you're going to hit OK. So basically what this tells you is the stock price has a strength which gets oscillated. It goes up and down, and this chart right here on the bottom is going to be in proportion with the stock price. So from 30, which is this bottom line, to 70, which is this top line, indicated in the yellow, the stock price will oscillate between the strength. So as the stock price goes down, you're going to see that the strength index, or the relative momentum index in this case, goes down below 30. So when it goes below 30, it means the stock is oversold. When it goes above 70, it means the stock is overbought. So anytime the stock is going down, you'll see that the momentum usually crosses, it goes down, it usually crosses 30. If it's oversold, it'll drop a lot. If it's going up, the momentum will go up. If it goes up really high, it means the momentum is going to go past that 70 line, meaning it's overbought. Right. So the key here is basically as the stock price goes from 30, crosses under 30, goes back to 30, there's going to be a drop. Stock's going to consolidate a little bit. And as soon as it makes it up past 30 again, stock price will shoot up. When it goes up past 70, right, it's going to continue going up until this starts to go back down. Once this starts going back down, you need to be a little bit more careful unless you're buying puts. Stock price is going to crash. If you see that the stock is going to go down a lot, normally you're going to see that this relative momentum index is going to go from overbought straight to oversold. So this is relative momentum index. I'm going to show you why I don't use the RSI. So I'm going to go to Studies, Edit Studies. I'm going to go here, type in RSI. Double click, add it to my lower, hit apply, and hit OK. So as you can see earlier, I said, I don't like to use RSI. I like to use relative momentum index, just because you can see all this noise, just up, down, up, down, down. It doesn't really give you the general idea, and for me, I like it being simple. I like the general idea. I don't like to have a whole lot of clutter. This is what makes graphs confusing. So I would say, forget about the relative strength index. Use relative momentum index. At least that's what I teach my students. I'm going to go ahead and I'm going to close that, hit apply, and click OK.